Howdy there, folks. Welcome into today's video. 3 videos to react to in this video here today. First one, Chartmaster says short Dow, buy S&P after Dow's outperformance. That video is shocking to me, okay? I'll explain in just a moment why that is so shocking, okay? Second video to react to here today, why small caps may be positioned for a breakout. Ooh, okay, talking right up my alley there. And the third video, a little bearish here, a little bearish. Gotta have some positivity, a little negativity in there, okay? Third video that I want to react to and give my opinion on. The Fed will likely kill the market rally. Oh boy, okay. Now, this first video is shocking to me. And the reason this is so shocking is because literally today, I was looking into ways to short the Dow in general. And I don't think I've ever had thoughts before to short the Dow. So the fact that I saw this here today, I was shocked by this because literally just today I added something to my potential stocks I might be interested in shorting or shorting opportunities for next year. Is one I added was SDOW, which is kind of like a 3x leverage on the Dow. So, you know, in theory, if the Dow went down like 10%, you know, like the SDOW should go down or should go up. You should make like 30% on your money. And the reason I was thinking about that is twofold. One is I obviously went into this year with no hedge at all, only long positions. And obviously, if you are going to be caught into a down market, you're going to set yourself up for some trouble, okay? The second reason is I was thinking, man, like the Dow has been way too strong, and if this baby keeps roaring for, let's say, the remainder of this year, it could be very attractive as a play to hedge for next year. Because I was looking at a lot of the Dow stocks, and I do not like where these stocks are trading. Never mind if this baby keeps pumping into the year end, essentially, okay? American Express, I feel like, is at fair value or overvalued. Amgen, I don't want to comment on. You guys know how I feel about Apple. I think Apple is going to have a very tough 2023 ahead, regardless of what happens in the economy. Boeing's been a mess. That's just is what it is. Caterpillar, I think, has got a tough 2023 coming ahead. They've been able to post really good numbers this year, but that's because all these projects and construction's been going on. I went really in depth in this in the private group the other day on the lag times in regards to interest rates and how that affects construction spending and all those sorts of things, okay? So I'm not a believer in Caterpillar in 2023. Cisco Systems is what it is. Oil and gas, I think, you know, we've already had a very bullish scenario kind of play out there. I think that could start to fall apart in 2023. As far as the financials, if you're talking about any weakening economy, the financials will get hit. Stocks like Home Depot have a lot of pain ahead, in my opinion, in 2023. You know, some of these stocks, it's just, you know, yeah, they all have issues, right? Johnson & Johnson's trading very rich. Coca-Cola's trading extremely rich. JP Morgan, if we're talking about any weakening in the economy, will get hit with credit risk and obviously, you know, have a substantial sell-off. McDonald's is massively overvalued right now. 3M is maybe at fair value right now. Mr. Softy is starting to have some weakening numbers, and obviously we saw that in the most recent quarter. Nike reported their last quarter. Revenue was up 4%. Their EPS was down like 22%, right? So that's a very troubling sign for Nike there. I actually went to the Nike store the other day because my son needed a new pair of shoes, and just a few days ago, actually. And something we saw interesting was quite a few things discounted. My wife got some things that were very attractive price, and let's just call it for Nike products. Procter & Gamble's trading rich. You know, you look at some of these, Salesforce, obviously trading rich, but it always is. Verizon and stocks like that. The trouble with those sorts of stocks is they're competing now with treasuries. And so a lot of people are looking like, why do I need to own one of these dividend stocks that I'm losing a bunch of value on the stock price when I could just be in a government bond or something like that and making really good returns? Visa's trading very rich right now. Walgreens, I like Walgreens. It's undervalued, but at the same time, no one appreciates that, so it doesn't mean the stock's going up. Walmart's trading decent right now. Disney's about fair value right now. So when I look at a lot of these Dow stocks, I'm not a believer, just to be honest, in 2023. And so if I'm thinking about hedging, this is why I even looked into like how would I short just the Dow in general? Because I thought about like individual stocks I would be interested in shorting as, once again, a hedge. It's not even necessarily to make money. It's more just a hedge in case things go south that I'll make money on the downside there, right? So definitely something I'm considering. All right, guys, hope you enjoy this. As always, appreciate you joining me. If you're looking to join my private stock group, get access to all the private videos in there, as well as our weekly investor report, access to our Discord chat, and including all the Discord chats with like-minded folks that are focused on buying the dips and adding ownership in positions that they love for the long term. Always we're always, covering all the breaking news in there with all the members and things like that, and get access to all my course curriculums. Check out the pinned comment down there to apply to join us in there if that sounds like something you'd be interested in. Alrighty, time to react to these babies. By the way, 18,000 plus subscribers on this channel now at this point. You got to be flipping my flapjacks. Thank you, every single person that's subscribed to the channel. Holy smokers, this ain't no dang jokers.
On a down note, with the Nasdaq dropping just over 1% and the S&P and Dow following suit, but it was a strong month for the major averages. The Dow locking in its best month since 1976 and its best October on record, outperforming the S&P 500 by 6 percentage points. Now, according to the chart master, Carter Worth, of course, that is the biggest spread since the 2009 financial crisis. He is now wondering if it might be time to short the Dow and go long the S&P 500. Actually,
if only I had $1 for every time over the past month or two I have heard this thing is happening for the first time since 2008 or 2009. If I had $1 for every time I've heard that over the last few months, I might be as rich as Warren Buffett. Holy smokers, this ain't no, it's insane. It's like this thing. It's like, it's just a trend, man. This thing just hit for the first time since 2008, 2009. It's crazy.
Not wondering. Hugh recommended that in a note. Guy, what would you say?
Well, I love Carter's work, and we actually talked about it on the 14th of October, and then again on Monday the 17th, that the setup for the market felt like it did in the middle of June. And, we thought there was a real chance the S&P could get to 4,000, which would represent about a 15% trough to peak gain, which made a lot of sense, and I'll stand by it. So I guess I'm with Carter Braxton Worth on this.
I mean, the underlying theory, according to Carter, is that there is a high correlation between the Dow and the S&P 500. So this divergence just doesn't make sense, and there should be convergence at some point, and hence going long one and short the other.
Yeah, but some of this, careful. This is just a handful of stocks if you're not careful. I mean, this could be Caterpillar, this could be United Health, this could be a couple pharma stocks and a couple energy stocks like Chevron. So, some of these trends are going to continue. I mean, healthcare's been defensive, big pharma's been defensive. I think energy remains defensive. So I kind of like this run for the Dow. I don't think it has to end overnight.
Well, it's funny, from a technical standpoint, I don't mean to kind of step on Carter's.
It's common that him and I disagree because I think myself and Tim Seymour always disagree. Like almost every single opinion he ever has, I disagree with. And he was obviously somebody that was very, very bearish on Tesla over the years. And obviously you guys know my opinion on that.
He is the chart master. But if you look at that Dow, the DIA, I never talk about it, but if you look at the downtrend that it has been in, it's about ready to get to that line here. So that could be a moment of truth for broader equities in general if the Dow were to get through that downtrend that's been in place since the first week of June. We also talked about small caps, which I think have some similar characteristics with some of the names that have worked really well in the Dow. They never made a new low. With some of these industrials and that sort of thing.
You mean like domestically oriented?
Yes, yeah, nice. They never made a new low, and they had a really nice bounce before the S&P and the Nasdaq.
All right.
Yeah, so, I mean, I don't really have too much to add there, because obviously I already explained my thought process there. So, I mean, if the Dow keeps pumping into year end, into December, it might be a move I make there in a smaller position sizing, but something that, hey, if things go south in 23, at least I can, make some pretty good returns there. And if they don't, the money I'll be making on all my other stocks will dwarf whatever money is lost potentially in that leverage Dow there, that it would make it so insignificant that it would be like, who cares? So that's kind of my thought process there. Okay. Alrighty, next video up here. Why small caps may be positioned for a breakout. Alrighty, we're talking about me. Me in regards to small caps, I think I've, unfortunately, and it's not like I went out of my way to do this, but I've been branded as like a small cap, the small cap guy over the last year. And it's because what's happened over the last year is I bought small cap stocks insanely heavy. Several of them. It's not like it's just one, it's a lot of them. But that's where I've seen massive opportunity over the past year. Obviously, the opportunity in terms of the upside still has to play out. But in terms of the stocks that are massively undervalued, where I've seen the biggest deals have been the small caps. Now, something's happened recently where large caps, even big tech, have opened up as opportunities now, which is very different and something we haven't really seen for years. Big tech stocks like Meta and Google and Amazon, those haven't really opened up as major investment opportunities until recently, to be quite frank. So, a lot of my focus, I think, in 2023, this is just me thinking things out is probably going to be on larger cap stocks in terms of, throwing money at stocks, whereas this year has been very focused on small caps. But once again, it's because that's where the dang opportunity is, and that's where companies are trading by far and away the cheapest, and not just by a little bit, by a lot, in my opinion. So let's get into this and hear what her opinion is and kind of give my opinion.
Says they are the place to be amid broader volatility. Let's bring in Nancy Pryl. She's the co-CEO at Essex Investment Management. Nancy, good to see you again.
Nice to see you, Melissa.
So we were just talking about small caps being more domestically oriented. Is the macro sort of backdrop that you're expecting one of recession, one of hard times for the U.S. economy, for hard times globally, and therefore you want to be more domestic?
Well, we think that we do want to be more domestic here because we think there are a number of drivers in the U.S. economy that even with what we think will be a hard landing, hopefully not a deep recession, but certainly a hard and a bumpy landing, the U.S. economy will look better and be stronger than most of the other economies, particularly those in Western Europe for the obvious reasons of Russia, Ukraine. We think that small caps in particular are really well positioned for this environment because they are levered to that domestic economy, and more importantly, they're levered to the industrial economy, which we believe will be leading us in the growth for not only the next year, but perhaps the next decade.
Nancy, it's Karen. Thanks for being on. So I don't follow the metrics of small caps that closely. Can you tell me where they sort of trade now relative to where they were at their peak?
Right. So small caps are still extraordinarily cheap. In fact, they are selling at valuations on both an absolute and a relative basis that are similar to where they were selling back at the 1999-2000 point. So they're selling at, depending on which part of the small cap universe you're looking at, anywhere between 10 and 13 times this year's earnings. Similar number on next year's earnings because the estimates for next year are pretty conservative. On a relative basis, they're selling at a very low percentage compared to the S&P, compared to their large cap counterparts. They're also under-owned.
Yes, under-owned. Very good point. I just did a little screenshot here of Yardini, kind of where things are trading at. I mean, it's very self-explanatory why I've been buying small caps this entire year, for very, very heavily, because we've been trading at pretty much the cheapest prices on a sustainable basis that you've seen since 2008. And outside of 2008, I mean, just the cheapest prices in decades. And so when you're going to give me an opportunity in the financial markets that's multi-decades of underperformance, essentially, right? And multi-decades, like below where it should be trading at, I'm going to take that opportunity. I'm going to buy it very dang heavy. And yeah, if it takes 6 months or 12 months to play out and start to come to fruition, it is what it is. But something I know from my time in the financial markets and the time I've studied prior to the financial markets, which is obviously, I studied all the way back to obviously the Great Depression. And then, majority of my study's been since like the 1970s, because that's more as we start to get into more modern financial times. What I've seen consistently is you can't trade for very long at unsustainably high or low valuations for stocks. You can do it for a bit, but it's not going to last, and things will come in line. And so when I look at small caps trading as cheap as they've been trading this year, it's not going to last, and they will pull up and they will get back to normal ranges where they should be trading at. It's a matter of time in regards to that situation, right? No different than large caps. Yeah, they traded up here for a 6 to 12 month span, but they couldn't last forever. You knew that eventually large caps were going to have to fall because we can't be trading at forward Ps in the 20 something range forever. And eventually we're going to fall back into the 16 to 18 range. And guess what's happened? Exactly that's played out. It's just a matter of time in these situations. So, and she obviously brings up a great point there about, these small caps being under-owned 100%. And people have learned recently, very recently, I'm talking over the last few months, about the risk of just being, let's just throw it all in the S&P 500. Let's just throw it all in big tech. You've been able to get away with that for a while. Let's just throw it into big tech. But look what's happened to big tech. I don't care if you're talking about, the biggest of the big guys. Look at a stock like even Microsoft. How much that one's fallen. Apple's still got its fall to come, in my opinion. Microsoft's obviously fallen tremendously. Look what's happened to Google. Look what's happened to Amazon. Look what's happened to Meta. That's a whole different level there, right? Look what's happened to Netflix. All those stocks that was like, throw money in it, you make easy money on these stocks, Shopify, all those type of stocks, right? they've all been wrecked, absolutely wrecked. And so people are starting to, I think, wake up to the realization of like, oh, it's a little more difficult than just throw it into the biggest tech companies and you're going to make a ton of money. And so that's where I think people start to get this adjustment in the market and start to figure out, okay, maybe some of these small caps are real opportunities, especially when they're trading at multi-decade lows in terms of valuations.
Compared to those larger cap stocks, particularly those great large cap growth stocks that have been driving the economy for the past decade or so. And so we think that with that valuation discount, with the better growth prospects, and with the lack of ownership, that puts them in a great position to appreciate as their earnings come through.
Just one follow-up to that. What is considered a small cap? What is the criteria that makes, I don't even...
Right. So it's a very tricky question these days because the traditional definition is that which is in the Russell 2000. Today, that encompasses stocks up to about 11 or 12 billion in market cap. So
my definition of small caps is definitely under $10 billion. She's mentioned 11 or 12. And specifically, when I really think about small caps, I'm thinking under $5 billion market caps. And then usually if I'm talking about under $500 million market caps, then we're starting to talk about like micro caps, which are, would fit companies like The Planet, companies like Avant Brands, companies like that would kind of fit that criteria in terms of like micro cap stocks. But yeah, so that's my definition. But it is true. Like everybody's got a little bit of a different definition of what a small cap is. And as time ticks on, right, and valuations of companies become bigger, right, eventually over time, like a small cap stock will be, everybody will look at a small cap stock and be like, well, that's anything under 20 billion, because that's just, the numbers just get bigger and bigger as history goes on, right?
It has gone up over the years. Of course, the definition of small cap goes up. We define small caps as stocks between roughly 250 million market cap and 7 billion on the high end. So not quite as large as where the Russell 2000 is. More importantly, one of the characteristics of small caps is that they tend to be less well followed, less well understood, less well known. And that's an important non-quantitative, but an important qualitative characteristic about the small cap space.
100%, because who knows? Like, you have to really go down the rabbit hole with these companies. It's not like a Meta, a Meta after that drop. Everybody in the world's talking about Meta stock. Even if people that don't even care about stocks or care about Meta stock are talking about Meta stock, right? Because it's this massive, large company, right? A lot of these small cap stocks, they're not even on people's radars, right? You have to have them come to your attention. Then you're like, oh, and so then funds can look into it. And so how you get that attention over time is obviously build your brand out and make your numbers undeniable over time in terms of your revenue growth, in terms of your margins, in terms of your cash flow and your profitability, right? And then you can get kind of noticed out there. And so it's similar to kind of in the sports world. And if you want to get noticed as like an athlete, for instance, and you play for like a small college, or excuse me, like let's say it's a small college and you're trying to get in the NFL or something like that. Well, geez, you're going to have to put up some insane numbers and do some insane things just to get that attention, right? And so no different in the small cap space. These companies got to put up amazing numbers. If they do, they will get that attention. Fund managers will start to invest in them and they will get into bigger indexes. They'll get into more ETFs and, everything can kind of be brilliant for there. But, it's very important. These, especially in terms of the money losing small caps, they get to profitability over the next year or two, because many of these ETFs and indexes and things like that won't accept a stock if it's not a profitable company. So it is something to keep in mind there.
Small caps, you like industrials, energy, and those involved with rebuilding the infrastructure. And I'm wondering, Nancy, because overall you think the markets are actually in for what sounds like a seasonally positive period, although the first quarter is going to be volatile. Will small caps outperform, their larger brethren during this period of seasonality?
We think they will. Certainly, small caps have been outperforming their larger brethren over the most recent period. They've outperformed in October, they outperformed in September, they outperformed in the second quarter. A lot of that is due to the valuation and due to the fact that the earnings are coming through. They're more domestically oriented, so the dollar has been less of a headwind for them. And we would hope that outperformance will continue as we go forward. As we said earlier, we think that we are in an economy that's going to be led by this industrial sector, driven by the forces of infrastructure rebuilding, reshoring of manufacturing, building out of supply chains. And again, that will benefit these companies. So they'll get recognized. And we think that the earnings growth, as it has been, at least at the beginning of this earnings season, should be better than that for large caps.
Nancy, thanks for your time. Good to see you.
Thank you.
Nancy Pryl of Essex. Guy, how you feel about small caps?
Well, we've talked about them. Go back to January of 20 before everything cratered. The IWM topped out around 166. Now, this June, traded down to 166, bounced. And we just did it again on September 30th. So I have a double bottom, past resistance becomes support. So this has some legs here. I mean, I don't think it's going to trade north of 210, but it definitely can make a push towards 200 in a tape that I still think is going to go up for the next week or so.
Historically, I've used small cap stocks as a hedge against things like emerging markets and things that are very growthy. And if you look at where the peak was on the IWM, really kind of coming out of COVID, it peaked as we were getting that reflation and that burst in rates in the first and early second quarter of 2021. And as the dollar has rallied, and you'd think this would be small cap positive, small caps have actually run into a lot of pressure. A lot of people feel like small cap companies, domestic companies, they're going to be okay. And in fact, they're very well insulated. So if anything, I think they've disappointed in a period where I think they should be doing better. But I would agree that the exposure here, or certainly
which goes into how the market can never make sense in the short term. Because you would think a lot of those companies, in terms of stock price, should be doing much better, and it hasn't been. It's just like, what, man? What? That's a market for you. Every time you think you got it down, it gives you something that's completely opposite. And it's like, why is this happening? What?
That we were just talking about with the Dow. I mean, I think this is a lot of the small cap exposure.
What kind of trade do you have on in small caps?
I don't. And, one of the things, and I don't look at investing in small cap. I think they're really hard to invest in a single stock basis. But if you do buy into some of the things that these guys are talking about as it relates to rotations, I think the IWM is a way to play it. I do think that relative strength is really interesting. If it goes back to those lows that Guy just mentioned and holds, I think you want a piece of that as you kind of think about 2023 and how you're allocating towards U.S. stocks.
Yeah. So why do small cap stocks scare a lot of these Wall Street folks, right? One of the reasons these small cap stocks scare these Wall Street folks is because many times it's hard for them to either they don't have conviction or they can't have conviction based upon kind of where their funds are and things like that. And with small cap stocks, I mean, if you think large companies are volatile, and we've seen an extreme amount of volatility this year, obviously an abnormal amount. Small caps can be way more volatile. If you buy into a small cap stock, you have to be ready to go down 50% plus on that stock. That's just bottom line. Most of the time in a large cap, you don't have to worry about that, right? Although in a year like this, that has happened, right? Very freak year. But in small cap stocks, even in a normal market, you have to be prepared to go down 50%. And so a lot of Wall Street won't even consider those stocks until they get bigger, until they get more established, until it looks like their net incomes are in a good place and are going to stay there. They can't consider those because they're seen as too risky, right? And so I understand it. It's part of the game, and it's part of, graduating as a business and making it to the next rank and to the next rank, okay? Alrighty, guys, next one up here. The Fed will likely kill the market rally.
He is Trivariate Research CEO and founder. With me here on set. What a month. It's good to see you.
Yeah, good to see you.
What happens now?
I think after such a historically bad Q2 and Q3, it's not surprising that you can get a pretty strong counter-trend rally.
You weren't expecting this kind of a move, were you?
For sure not. I think we did talk about rhetoric maybe was more negative than positioning, right? Everyone knows the obvious. Inventory is built, earnings are too high, there's quantitative tightening. I think this rally was more about people thinking the Fed is getting closer to pausing or speculating on when they get directionally dovish than it is fundamentals. What I've been talking most with my clients about in the last few days is this thing I started socializing with you a month or two ago. Could this just be a very slow decline? Kind of an erosion, not an implosion.
Wow, I wonder if anybody called this epic rally. Wonder if anybody did that. Wow. Interesting.
And then I can then look and say, there's things that are probably on sale if that's the case. Cyclicals that are so cheap, they're discounting an implosion that's not likely. Quality businesses that are now barely above where they were before 2019, yet they can probably grow through this decline. And so maybe 2024 earnings are below 2023, but maybe there's a bunch of businesses that I still think are a decent deal in that light. And I think that's been kind of dominating my investor conversations the last few days.
To your point about, how negative everybody and everything seems to be, Lloyd Blankfein tweeted something a couple days ago that I want your reaction to because it speaks very much to that. He, of course, the former Goldman Sachs CEO. Seems everyone, all caps, negative on the market with sticky inflation, more rate hikes, other bad stuff ahead. Yet, inconceivable for all pundits to be right, but often all are wrong. Positives may be lurking. Fed pause, Ukraine truce, China lockdown end, etc. Sentiment can shift suddenly. What do you make of that?
Sentiment, by the way, not sediment. Sentiment can shift suddenly, absolutely. In terms of China, don't get your hopes up about that. In terms of Fed pause, I don't think we're quite ready for that yet. But if 2023, I think for sure. I'm hopeful that something happens on the positive front there in 2023, but that you can't hold your breath on. So I agree with this part. Sentiment can change, can shift suddenly, but in terms of those, don't hold your breath on them.
It can shift suddenly. I mean, I think we have a very high nominal GDP starting point, the result of, this pig through the snake on COVID, so to speak. So that's going to work its way through slowly. I think what could surprise people is, we just have a little bit of a decline, and it takes longer to totally decline. And then there's businesses that are pretty good companies. Like we're in our research, I think you saw it this morning. Home builders trade somewhere between 2 and 5 times earnings. So let's say they're 30% too high, 40% too high. Can I still buy best-in-class home builders at 5 times earnings if the real number's 9? Maybe.
I know, but so that's why I say those stocks are extremely hard to short right now, right? Because I'm very negative on housing, very negative. I think everybody knows that by this point in time, right? I've been extremely negative going into this year because I thought demand as we went further along in the year, as far as new home demand is just going to keep falling, and that's sure enough exactly what's played out. I think it's going to get even worse, likely in 2023. And so that makes the environment for the home builders to be, very negative. But at the same time, you could say if earnings were to fall 50%, they're still trading relatively cheap on the market, right? They have to basically get to places where they went to in 08, 09, 2010, 2011, where they were actually losing money, which for there, we have to have the complete collapse of the real estate market and a complete crash. And that's definitely a possibility, but that's a harder thing to pull off than just a massive slowdown and, a bad real estate situation. But there's levels to how bad that can get, right? And so that's why those stocks are hard to short, even though I'm very negative on real estate. It's a great point.
In the past, I haven't been there. Now they're down a lot, and I think maybe it's more interesting, right? I mean, it's always entry point, right? As you know, I love energy and I love metals. They're really cheap. They're embedding a massive earnings decline, and it might just be an erosion and not a massive decline.
But I feel like you have been talking about more of an implosion over these last many weeks, at least in earnings. Aren't you looking for earnings to come down like 30 to 50%? Or
no.
How much you looking for them to come down?
I think around 220 is reasonable. The street's at 235, so you're kind of in that 12% too high range. I'm warming to the fact that maybe it'll be 7 or 8% too high, but then 24 will be below 23. We've never posted a number like that. No, I think it's just that the multiple is the hard part for me, right? The volatility of that price to earnings ratio, it's far greater than the volatility of the underlying earnings. So when the Fed gets anything dovish, we know the multiple is going to expand. What I don't know is are the earnings going to be a little bit lower? That's the tension. And if I have a 2-year yield that's well above 4%, it's hard to think the multiple is going to expand a ton. I think that's the tension.
Do you think the Fed's going to extend the rally, or kill it this week?
If I were guessing, and I'm not good at that, but I would say they're going to kill it.
You got to model in certain things. You're good at that.
I think they're going to kill it. I think they're going to be a little bit more hawkish than the last couple of weeks of sentiment would otherwise dictate. I think they're going to say we still have some inflation issues in certain areas and we want to get it under control. But listen, that would just be using the prior 10 conversations to lead to my 11th conclusion.
I mean, Shepardson of Pantheon Macro says the conditions are falling into place for potentially the Fed to do its last hike in December. Unambiguous signs of weakening labor demand, falling business investment intentions, falling rents, collapsing support for overstretched profit margins. Change is coming, making it much more likely that the Fed's final hike will be in December. Is that like a tremendous outlier view? Can you get your arms around that?
I don't think that's an outlier view. I think the consensus has moved toward some pause at some point in the next 6 months, and it's moved there pretty quickly. I think They've been consistent that CPI is one of their main governors. I remain pretty high conviction the CPI will remain elevated. So whether they're waiting for some 5 handle or I don't know to really get dovish, we'll see.
Yeah, so, in regards to the Fed and that whole situation, right, we can talk about it from 2 points. First one is the market. So in terms of the market and the way they'll look at that, and then we can speak on, obviously, is it realistic that the Fed might pause in December or that's the last rate hike or something like that, right? In terms of, let's talk about that one first, okay? In terms of the Fed pausing or that's their last rate hike in December, do keep in mind, they lag. So I wouldn't be surprised if the Fed shoots too far to the other side here and just keeps raising rates even into early 2023 and probably drives things too far the other way. Because they lag the other way, it's not impossible to imagine them going too far on the other side and actually causing much more damage to the economy at a time point when maybe they shouldn't be. And when everything for inflation is kind of lining up as far as that goes, right? In terms of the market and how the market will take the whole Fed situation, you don't want it on the day of and the day after. That's anybody's best guess, right? But I do think the market, I feel a vibe of the market's getting sick of the Fed and paying attention to the Fed. And eventually, the market's not going to care about the Fed anymore. And the conversation will not be the Fed and won't be inflation anymore, right? And so it seems like we're starting to get to that point. And when you get to that point, it's very interesting because the attention starts to move somewhere else in the market, right? Now, it's easier to drive that attention somewhere else when you're in earnings season, which is what we're in right now. We're in the heart of earnings season. Next 2 or 3 weeks is still massive amounts of earnings. Even though big tech reported, we still got so many earnings coming next 2 or 3 weeks. That's still where the attention is on earnings, right? Once you move past earnings season, then it's like, okay, what do we focus on now? And then it starts to kind of shift back to the Fed. But, the market gets sick of things. That's just the thing I've always noticed throughout my 14 years in the market is eventually everybody pays attention to something for maybe 6 months, 9 months, and then they just grow old of it, and they're like, I don't really care about that anymore. We're going to move the market where we're going to move the market based upon these other things now, right? And so that's just kind of something to keep in mind there, that if the Fed does this or does that, doesn't mean necessarily the market's going to move there anymore, just for the mere fact that I think a lot of these fund managers and investors in general are so sick of talking about the Fed that they're at this point, they're like, I don't even care anymore. I'm going based upon where I think these companies' earnings are going over the next year or so. So anyways, hope you guys enjoyed this video. As always, I appreciate everybody that's subscribed to the channel. 18,000 plus subscribers now at this point in time. Absolutely amazing. Thank you, everybody that's here. And then once again, if joining my private stock group sounds like something you'd be very interested in, check out the pinned comment down there and apply to join us in there. And once you join, say hello to me. Much love as always, and have a great day.